This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. I'm your host, Harvey Blankfeld, along with our co-host, Shelley Brown, and we've been selling homes here in Southern Nevada since 1988. Shelley and I are also very proud to be part of the Real Estate Radio Network. That is a national network of local real estate professionals delivering timely, balanced truths about local market conditions. We got Bill Nelson and Jeffrey Edwards. They're here from Piercy, Boulder, Taylor, and Kern. And that's a CPA firm that's been in Las Vegas and doing accounting stuff here for 25 years, right?
Right. We're just celebrating our 25th anniversary right now. And good morning, Harvey.
And I know a topic on a lot of people's minds is this gross margins tax. Can you help me to try to understand what's going on with this thing?
Gross margins tax, the legislature calls it the commerce tax. And when you read the literature, it says in the first paragraph, for the privilege of doing business in the state of Nevada, we're going to enact a tax. And it's computed off your gross sales.
Okay.
You could literally have a net loss for the year and have to pay tax on this commerce tax.
Because it's based on gross revenue. Gross revenue
as opposed to net income. You start with your gross revenue, and there are a few exclusions that you can take into account. For example, let's suppose that you have a sister company, and the sister company pays you for services. You can exclude the income from a sister company because they're not going to get a benefit for the expense that they get. And then there's some other exclusions that have to do with gain on the sale of real estate and other gains. And then there's some other exclusions, and we're not going to go into that. They're minuscule. But you take that gross revenue, you subtract out your exclusions, and then you subtract out $4 million. You get a $4 million bump.
So it starts at $4 million.
Yeah. So
okay.
if you have gross revenue of $3.5 million, you're not going to have to pay the commerce tax.
Okay.
If you have gross revenue of $4,100,000, you're going to have to pay the commerce tax on $100,000.
So it starts at 4. So it doesn't go back to for $1. It starts at $4 million and above.
Right.
Okay. What do I want to be thinking about as I'm getting closer to year end, as I'm getting ready for paying my taxes next year?
Well, first thing you need to look at is, am I making money this year? And if I'm making money this year, then we need to look at some tax planning strategies.
Right.
We don't like to say we need to go out and buy a deduction, but if we have a need and we have an opportunity, we need to take that deduction. If I'm in the 28% tax bracket, and I need to get a deduction, I'm going to have to spend. If I spend $100,000, I'm going to save $28,000 in taxes.
Mm-hmm.
So you don't want to buy that deduction.
Right.
However, if you're in a position where you need new equipment for your business, and you're ahead of the game when it comes to income, you might want to think about what needs you have coming up with new equipment or vehicles, and then you can benefit from aggressive depreciation strategies.
What about in our own personal?
In our own personal
taxes,
there's some opportunities when you look at a IRA or a SEP IRA. Or a Roth IRA. If we're young enough, we want to let that money grow tax exempt. We throw it into a Roth IRA. We pay our tax up front.
Mm-hmm.
If we're in a traditional IRA, we put our money in and it's tax deferred. We don't pay tax on the money that we contribute to that IRA.
Right.
You've been listening to Las Vegas Real Estate Now with hosts Harvey Blankfeld and Shelley Brown. Please tune in every Saturday at 11 a.m. right here on News Talk 720 KDWN.